basically they want out. They don't want the silver contract anymore. I mean, nobody can make any money out of it because there's no silver. So when it comes to price, the price is actually being made in Shanghai.
Markets expect the conflict to be over soon. If you just look at the number of rockets and drones shot by Iran, it's going down drastically.
Major Chinese banks have basically run out of gold bars. That, I think, is probably where the push is going to come from. People going into gold. That, I think, is the next move up. It'll leave silver with it. You know, the big banks, members of the LBMA, the active dealers on Comex are trying to get the hell out of silver because they can see what's coming.
Is JP Morgan then sort of used as a conduit perhaps to extract that silver and send it to Uncle Sam?
I mean, you've got a problem in London, you've got a problem in Comex. Prices in Shanghai are way ahead of in our paper markets. There's no speculative interest in this. The last 2 days, open interest in silver has now fallen to the lowest level we've seen for 20 years. You listen to Trump, he hasn't got a problem. They're going to beat the shit out of these guys, sort of approach.
That could also explain the rise in gold and silver prices over the past few months. Of course, it's corrected a bit, but perhaps gold knew.
Well, that's absolutely right. At the moment, there is lots of confusion in the market, I think. I mean, I'm amazed that equities haven't fallen more. They will fall more. It's as simple as that. I'm amazed that bond yields haven't risen more quickly. I mean, people get terribly excited when the 10-year Treasury note yield rises by 6 basis points or something. Oh, come on. You know, this should be 100 basis points and then some in the short term. So that's all a bit sort of odd. I think the markets are sort of, if you like, frozen into inaction in that sense. And so these moves are not major at all yet. Of course, the other sort of, if you like, gut reaction is that when things are not looking too good, what do you do as an investor? You go into you go into safety. Where's safety? The dollar. You go and buy the dollar. So we've seen the trade weighted rise from, I think it was 96 and change up to we're currently 98, 99, something like that. Not huge, but you can see that it does reflect this Keynesian, if you like, gut reaction, or macroeconomic gut reaction. I think that's a better description, which is completely wrong, because what you're seeing is the value of credit being undermined.
Traders are treating dollar strength like a defensive reflex rather than a true signal of stability. As Alasdair Macleod points out here, equity and bond movements are muted despite systemic risks, suggesting the market is frozen in inaction and not reflecting real economic stress. The 10-year Treasury's tiny 6 basis point move feels disproportionate compared to historical volatility that could easily reach 100 basis points. Meanwhile, the trade-weighted dollar has edged up modestly to 98 to 99, highlighting that investors are leaning on safety rather than growth. The underlying issue is credit devaluation, which mainstream narratives rarely address. Next, Alasdair Macleod talks about how these hidden credit dynamics distort gold and silver pricing trends.
What is the dollar? It's just credit. But of course, not many people realize that. They will wake up to it. And I read a credible report this morning that major Chinese banks have basically run out of gold bars. So, that I think is probably where the push is going to come from. People going into gold, I think the big stuff going into gold, that I think is the next move up, and it'll leave silver with it. I mean, this is why I think that, the big banks, members of the LBMA, the active dealers on Comex are trying to get the hell out of silver because they can see what's coming. What we didn't know at the time was that the Chinese also took a decision effectively to ban silver exports. Now, all we know is that there's a new silver export licensing regime which came in from January the 1st, and it was going to last in 2026 and 2027. That's all we know. But it's quite clear that somewhere the Chinese took the decision that with suddenly America turning around and deciding that silver is a critical mineral, and guess what, they haven't got any, what China was not going to supply silver to the West only to find it ends up, if you like, providing a strategic silver stockpile from America.
Headlines about gold demand overlook the strategic squeeze China is imposing on silver. As Alasdair Macleod points out here, major Chinese banks have reportedly exhausted gold bars, while silver export restrictions create scarcity for Western buyers. LBMA members and Comex dealers are reacting by offloading positions, signaling institutional awareness of an impending supply crunch. The US designating silver a critical mineral collides with China's refusal to supply, amplifying tensions unseen in conventional commentary. This hidden scarcity sets the stage for coordinated upward moves in precious metals. Next, Alasdair Macleod discusses the implications of Chinese stockpiling on silver and market stability.
Why should they do that? And it was interesting because, this was all in the more or less the last week or so of September. By October the 9th, there was a crisis on the LBMA because there was no silver. And lease rates shot up to 40%. I think on the 10th, they had to suspend trading for something like 1.5 hours while they sorted out the mess and all the rest of it. And we've now got the situation where the silver's running out of Comex at quite an alarming rate, certainly registered for delivery. That's running right down. I mean, it's 86 million ounces or something, which is not a lot. It's something like 17,000 contracts. But the interesting thing is that the bullion banks and market makers swaps, if you like, on Comex are basically trying to get out of the contract. There's no speculative interest in this. I mean, the fascinating thing is this morning we see that in the last 2 days, open interest in silver has now fallen to the lowest level we've seen for 20 years. I mean, just think of that.
Yeah. Could you explain in layman terms, what does it mean exactly then for someone who doesn't understand what open interest means?
The open interest collapse in silver markets is a warning few investors appreciate. As Alasdair Macleod points out here, Comex contracts are being shed aggressively, and lease rates hitting 40% on October 10th exposed severe stress in supply chains. Registered silver for delivery is down to roughly 86 million ounces across 17,000 contracts, highlighting an acute scarcity problem, masked by paper markets. Market makers and bullion banks are exiting, revealing that speculative appetite is essentially zero. This disconnect between supply realities and market pricing is a critical signal for investors. Next, Alasdair Macleod shows how these conditions amplify systemic risk in silver trading.
So could you explain a little bit more detail what it means that we now see a low in 20 years when it comes to open interest on Comex?
Well, there's absolutely no speculative interest in there at all. Basically, this is something which it doesn't matter what the price is. They move the price around. I mean, the arbitrage between markets is actually very severely hampered. I mean, you've got a problem in London, you've got a problem in Comex. Prices in Shanghai are way ahead of where they are in our paper markets. But the problem is that if you import silver into China, you have to pay 13% VAT. So basically, Chinese prices, ex-VAT, are 13% above where they are in the West, because if you're going to do the arbitrage, you've got a 13% cost on top of shipping costs and all the rest of it. So that's the markets are not working.
But does it also mean then that with open interest being this low, it means that the manipulation by bullion banks has also dramatically been reduced, or is that still going on?
No. The manipulation continues for as long as they can manipulate prices.
Even with open interest at a 20-year low, price manipulation persists unseen. As Alasdair Macleod points out here, speculative activity is negligible, yet bullion banks continue to influence markets while arbitrage opportunities are blocked by a 13% VAT on imports into China. Shanghai prices are already ahead of Western paper markets. reflecting structural inefficiencies rarely discussed in mainstream coverage. Investors relying on Comex data are misled about liquidity and true demand. The market is functioning less like a free price system and more like controlled exits by major players. Next, Alasdair Macleod unravels how manipulation continues despite the apparent collapse in open interest.
No, what's happening basically is that the price is not being made on Comex. They just want out. And, obviously you've got the problem. Okay, how do we get out without recording huge, great losses and maybe people going bust? I mean, you've had two instances on Comex now where, I can't remember what it was, but, it was all overheating. So, the database had to shut down and so on. This is when silver was running sort of quite strongly. And then on the expiry of the March contract, or rather, when it was sort of the first day of notification, if you like, about stands of delivery and all the rest of it, there was another sort of technical problem, and suddenly you found that there was quite a large number of contracts were declared invalid. Look, this is a market which
that's convenient. Yeah.
Basically they want out. They don't want the silver contract anymore. I mean, nobody can make any money out of it because there's no silver. That's as simple as that. So when it comes to price, I mean, to answer your question another way, the price is actually being made in Shanghai, not here anymore.
Comex is no longer the benchmark for silver pricing, yet investors still rely on it as a signal. As Alasdair Macleod points out here, systemic problems, from database shutdowns to invalidated March contracts, reveal that the market is struggling to process delivery obligations. With bullion banks and traders seeking exit strategies, there's no liquidity or real price formation left in the West, shifting true pricing to Shanghai. This hidden shift means conventional paper markets misrepresent scarcity and demand for Western investors. Next, Alasdair Macleod unravels why Shanghai now dictates global silver valuations.
Yeah, but I have to deal with European prices. Like if I buy silver or gold for my business, for Holland Gold, I will have to deal with Swiss and German refineries, and they're basing themselves on LBMA and Comex prices. So the prices are still being made for me here in Europe, not in China.
What a wonderful opportunity for anyone who actually understands what the hell's going on.
Yeah,
I mean,
they should profit from those prices.
Yeah, exactly.
Yeah.
Exactly.
And if the US is in dire need of silver, why do you believe? Because it's something that Luke Roman told me when I talked to him, and he said that NATO is buying up all the silver. So the fact that Comex is being drained, does it mean that a lot of that metal is actually going to the US on the sovereign level? And is JP Morgan then sort of used as a conduit perhaps to extract that silver and send it to Uncle Sam?
Well, we don't know is the answer. I mean, military use is very, very important. But by far the larger market is photovoltaics and electric vehicles. So I think that's almost a slight side issue. The important point to understand is that the US government has now decided that silver is a critical mineral. It needs to have a stockpile of silver to secure its interests, if you like. So basically, the US government is a buyer of silver. I mean, big time. And the Chinese are refusing to supply it. What happens? The paper markets in the West suddenly are in crisis. I mean, it's not surprising, really. That's all you need to know.
European silver prices are tied to paper benchmarks, not the real supply crunch in Shanghai. As Alasdair Macleod points out here, Swiss and German refineries follow LBMA and Comex prices, masking the global shortage and creating an opportunity for those who understand true flows. The US is actively stockpiling silver as a critical mineral, while Chinese supply is withheld, adding strategic tension that paper prices don't reflect. Photovoltaics and EV demand amplify this structural squeeze. Next, Alasdair Macleod discusses how sovereign purchasing and supply bottlenecks impact long-term market stability.
But could you also argue then, if you look at the dollar at the moment getting stronger, if you look at stock markets not moving that much, that the markets expect the conflict to be over soon? If you just look at the number of rockets and drones shot by Iran, it's going down drastically as well. So perhaps just like last year with the 12-day war, Iran has a big mouth, but is in the end not able to do much. Of course, there's huge chaos at the moment in the Middle East with all sorts of unintended consequences. But the market may assess the whole situation as, okay, give it a few more days, and it's business as usual.
Yeah, I think markets are buying, if you like, the propaganda from the West. I mean, you listen to Trump; he hasn't got a problem with this. We're going to beat the shit out of these guys, sort of approach. But the reality is that Iran has been stockpiling and building defense over the last 40 years. If you look at Western ordnance, I mean, basically they've been depleted by the Ukraine situation. And also, you have this situation where when they send in a drone, when the Iranians send in a drone, it costs them something like $20,000 to $30,000 equivalent.
Markets are pricing diplomacy, not destruction, which could mislead investors. As Alasdair Macleod points out here, the dollar's strength and flat stock indices mask that Iran's long-term stockpiling and decades of defensive buildup remain largely unchallenged. The cost of each Iranian drone, $20,000-$30,000, versus minimal Western strategic response, highlights inefficiency, not deterrence. Headlines suggesting conflict is ending soon ignore these structural realities. Investors need to adjust for hidden risk, not just visible headline data. Next, Alasdair Macleod talks about the economic and strategic implications of Iran's underreported defensive capacity.
But to try and combat it, Israel, America, whatever, are spending huge amounts of money trying to just shoot down one drone. So, the symmetry, the asymmetry of this war works very much against the West.
But the same applied last year, right? But at some point, Iran also stopped shooting drones. And if I look at the numbers, on the 28th of February, Iran shot 800 drones, and on the 3rd of March, 150. So It seems like they are losing their capacity, or maybe they're holding back. That they're changing tactics, but.
I think that they're holding. I think they're holding back in a sense. From what I understand, and I don't know that this is entirely true, but I suspect there is quite a lot in it. The Iranians have been expending, if you like, some of their older technology initially. They understand the problems, the logistical problems that the Americans and Israeli have, in the sense that there is a shortage of ammunition rapidly developing. They are letting them waste their resources, and then Iran will deploy its more advanced weaponry. And we're looking at hypersonic missiles, which it appears the Iranians have. And people who know about these things say that these things have a speed of Mach 7.
The apparent decline in Iranian drone activity hides a strategic advantage Western observers often miss. As Alasdair Macleod points out here, shooting down hundreds of drones cost the US and Israel significant resources, and Iran may be conserving capacity for more advanced hypersonic systems. February 28th's 800 drones compared to March 3rd's 150 suggest tactical restraint rather than depletion. This asymmetry shows how operational cost, not just numbers, defines battlefield leverage. Investors should consider these hidden dynamics when assessing geopolitical risk premiums. Next, Alasdair Macleod discusses how evolving Iranian technology could reshape conflict economics and market sentiment.
So,
but they lost already the whole fleet, right? Iran lost its whole naval fleet already, so they shouldn't wait too much longer.
No. They haven't lost their fleet. What they have done is they have lost some of their ships. I understand it's something like 10 out of 40 ships. But this is not a naval war. This is a land war. I mean, where is the American Navy? Hiding out in the Arabian Sea beyond missile range. This is not a naval war. Yeah. Now, President Trump overnight says, well, we will escort tankers through the Straits of Hormuz. I mean, honestly, the man's an idiot. I mean, basically, the first thing that will happen is that American warships will face a barrage of missiles, and they won't be able to defend themselves against it. And then you are going to
And there's no insurance either, right? It cannot be insured. So even if the US protects the ships on paper, most of these Western companies like Mars, they don't even want to go there because of the lack of insurance.
They can't because they can't get insurance cover. And in any event, even if they got insurance cover.
The naval narrative is misleading investors into underestimating risk. As Alasdair Macleod points out here, the US Navy's presence is minimal, and only 10 of 40 Iranian ships have been lost. This is a land-centric conflict, not a maritime showdown. Insurance gaps make Western commercial shipping essentially non-viable, highlighting how real-world risk exceeds headlines. Investors assuming a smooth flow of energy or trade are overlooking a systemic insurance-driven blockade, which could ripple into energy and shipping stocks. Next, Alasdair Macleod discusses how these hidden operational and insurance risks affect global strategic positioning and market perception.
I would very much doubt that they would want to risk their crews. It's just a crazy situation. They cannot actually counter what Iran is doing. So, Iran actually doesn't need to shoot anybody. I mean, the insurance companies do it for them, in effect. It blocks, it's the insurance companies that are the blockade. But if the Americans try and open this up, sort of by naval escorts, I mean, I can see people in the Pentagon saying, oh, hold on a minute. Whoa, we're not doing that, Mr. President. You can forget it. I think the point is that, I think back in the US administration, there are a lot of people who actually understand that this is a big, big error. They can't admit it in public. But as this unfolds, the knives will be out for President Trump. I think that's the key thing to understand from the Pentagon's aspect. As for Israel, that 12-day war gave the Iranians a lot of intelligence as to how to defeat the Iron Dome. And they're managing to do it with, not their most advanced technology. They know what they're doing. I mean, these guys are smart.
The blockade effect comes not from missiles, but from insurance policies that enforce it silently. As Alasdair Macleod points out here, the Pentagon recognizes that attempting naval escorts risks lives and exposes operational limitations, forcing a strategic standstill. Iran's prior 12-day war provided intelligence on defeating the Iron Dome, indicating a learning curve that Western media ignores. Investors need to price in geopolitical leverage created by financial mechanisms as much as military action. Next, Alasdair Macleod talks about how these indirect tools of control influence market risk and investor strategy.
Maybe as a final question for all these listeners that also want some guidance in terms of what they should do with their savings and with their portfolio at the moment. Of course, you're still a big advocate for gold and silver. Commodities you just mentioned. Would you also advise to keep some cash at hand should stock markets collapse to be able to buy on the cheap?
Well, basically get out of credit. Get out of the worst credit. Yeah, I mean, we always need a little bit of liquidity. Of course we do. And it's not practical to get entirely out of credit. But just bear in mind that what has been fueled is an equity market bubble. And the idea that you can accumulate wealth by buying decent equities and all the rest of it over a period of time.
Investors are assuming stability while bubbles silently inflate beneath their feet. As Alasdair Macleod points out here, exiting weak credit and holding liquidity is essential because the equity market bubble inflates faster than conventional analysis admits. Gold and silver remain the only reliable hedges as rising volatility could wipe out paper gains. Waiting to buy on the cheap requires understanding that conventional equities are over-leveraged and risk concentrated in the wrong sectors. Next, Alasdair Macleod discusses practical steps for reallocating portfolios toward real assets and away from credit exposure.
No, those days are gone. And when the bubble pops, it doesn't matter how good the equity is, its value will collapse along with the rest of it. And what will pop the bubble? Well, rising bond yields. And we can see the scenario where that's going to happen. I mean, they're not going to stay where they are with rising inflation over 2026, that's for sure, whatever happens in the Middle East. So get out of credit. You've obviously got to have a bit of liquidity, if you like, for the idiots who still take credit, but get out of credit. And the only way you get out of credit is to get into real legal money in everybody's common law, which everybody has forgotten, except me. I'm on a one-man mission to try and educate people in Roman law, which is where the basis of all our common law comes from. Real money, which is without counterparty risk, is metallic, physical metallic, and it's gold, silver, copper. Now, copper is very tiny change, though none of our copper coins are copper anymore.
Rising bond yields threaten all equity, regardless of company quality, and credit exposure magnifies the risk. As Alasdair Macleod points out here, liquidity alone isn't sufficient. Moving into legal, physical money like gold, silver, and copper protects against systemic collapse. Paper wealth tied to credit will evaporate once inflation pressures lift yields over 2026. Investors ignoring these fundamentals face asymmetric losses, particularly in bonds and highly leveraged equities. Next, Alasdair Macleod shows why real metallic assets are the ultimate hedge against both credit and market bubbles.
Silver is, is change. We don't have any silver coins anymore. But gold, if you like, is the big beast in this. And that's why central banks are buying it. And what are central bankers doing? They're getting the hell out of credit, out of other people's credit, if you like.
Yeah.
Quite happy to produce their own credit, but they want out of other people's credit.
Yeah, because they understand the scam.
Yeah.
Central banks are quietly signaling distrust in conventional credit while accumulating gold aggressively. As Alasdair Macleod points out here, silver has become negligible as currency, while gold dominates as a hedge against counterparty risk. By exiting third-party credit and producing their own, central banks reveal the fragility of the financial system that most investors ignore. Understanding this shift is critical for portfolio allocation, emphasizing physical metal over paper claims.